There's a process called the INAV, indicative NAV, that is quoted every 15 seconds of what the underlying basket of stocks should trade at. And that is helpful in sort of the formation of price discovery, because you know when you price up all 500 stocks, what the overall value of that basket should be. And if it's trading outside of what that value is, then someone's going to come in and tighten that to bring it back into equilibrium. And that's a self-reinforcing arbitrage mechanism of ETFs.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
All right, everyone. Well, welcome back. I hope your year's off to a good start. I wanted to mix things up a little bit, and I'm very excited to have our first guest of the podcast. We have Matthew Bartolini. He's the managing director and head of Spider America's research at State Street Global Advisors. Welcome, Matthew.
Welcome. Thanks for having me.
Yeah. As a lot of you know, part of the services that we offer is managing clients' portfolios, and a lot of the portfolios that we manage are focused on using exchange-traded funds, some of which are Spider funds that we use. And so I wanted to get into talking a little bit about ETFs, exchange-traded funds as they're known, how they work, and giving you some tips on how you can implement strategies in your portfolio. And this is going to be the first of 3 episodes that we're going to conduct with Matthew. So Matthew, tell me a little bit about your background.
Yeah, so Boston, born and raised, so naturally worked for State Street. We really worked at all different aspects of State Street Bank. I started out on the custody side out of college, working fund administration, learning about fund accounting, and then throughout time went over to the asset management firm at State Street Global Advisors. And then around 2016, 2017, we started working on the research team and ultimately became the head of the research team that shortly thereafter. So I really saw a lot of different aspects of State Street, which then means I saw a lot of different aspects of ETFs, just given that we were the innovator in that space, and not only from a custody side, but from an asset management side, and just seeing all different aspects of the ETF throughout my career.
Sure. Yeah. For those not from the Northeast maybe or not familiar with State Street, tell me a little bit about State Street.
Yeah. So State Street, large custodial bank, over 29 trillion in assets under custody. We also have an asset management arm, which is where I sit with State Street Global Advisors. Been in business, State Street proper, basically since the 1800s, providing, merchant financing way back then. A lot of our core businesses now are providing those custodial services for fund administration, fund accounting, asset management with State Street Global Advisors. We also have a global markets team and global data services team as well within State Street. So sort of 4 main different functions within the broader State Street Bank. And of course, I reside within State Street Global Advisors, where the ETF business resides as well.
Okay. And how big of a company is State Street? How many employees do they have, you think? If you were to guess,
If I were to guess for overall broader State Street, it's well into the thousands. I actually probably couldn't even tell you the exact number. I do know that we have within State Street Global Advisors basically 9 different investment centers and over 3 trillion in assets under management. So quite a big firm. We have clients in over 63 different countries and a lot of different global reach from that perspective.
Sure. Yeah. So one of the really large players in the investment sphere and definitely the ETF sphere as well, as you could say. So a book that I read a while ago is the ETF Institutional Toolbox. A good read, I would suggest, if anyone's trying to increase their knowledge on ETFs, not only the history, but on different strategies. And there was a story that was mentioned there about how ETFs came to be created. Is that something that you could tell us a little bit about?
Yeah, so it was really born out of a crisis. In 1987, we had the massive crash within the broader U.S. equity markets. And as a result of that, the SEC put forth a commission to understand some of the rationale why there was such a massive crash that day. And one of the results was that perhaps there could have been a buffer of liquidity where instead of having futures contract, which a lot of program traders were just selling, and that was having this sort of natural reinforcing loop and creating more selling program traders, if there is, say, a physically backed futures contract, something that would be exchange traded that could be backed by underlying shares of the company, therefore it doesn't have this sort of constant feedback loop of just constant selling, because there would be impact on the underlying securities and what have you. And that ultimately led to the formation of the ETF. That report was written by the SEC, and then in partnership with the American Stock Exchange, State Street Global Advisors came together and launched the first ETF in the US with SPY to be the sort of
SPY?
Yeah, SPY, the Spider S&P 500 ETF, to be that sort of physically backed futures contract, to be a buffer for liquidity in times of market stress. And that was the premise of ETFs. It was not this sort of low cost vehicle that a lot of people use now for buy and hold. It was really as a sort of trading instrument for the trading community to help with the formation of liquidity in really severe market stress. And fast forward to 2020, and we continually see that play out. ETFs this year broke all-time highs in trading volumes as investors gravitated towards the structure for liquidity purposes during the market turmoil that we witnessed this year. And SPY actually traded over $100 billion on the secondary market one day, which is a record. And SPY is the only security, like single stock security ETF, to ever trade over $100 billion in a single day. So it sort of goes to show the premise that was set forth out in 1987 by the SEC and then grabbed on by the American Stock Exchange and State Street Global Advisors. Really, that premise was delivered upon some 27 years later and all throughout that time span as well.
Okay, interesting. Yeah. So how long was after SPY came about, would you say that the adoption of that started to take hold?
So, the ETF business really was only a handful of funds and a handful of issuers, really up until about, say, 2007 or so. And there was sort of a slower adoption. There was obviously areas for innovation. In 1998, we launched the select sector spider ETFs that carve up the S&P 500 into the different economic sectors like financials and telecom and technology. And then you start to see a bit more instruments coming to the marketplace that, say, focus on style box investing. Or then in 2002, you started to have fixed income, then international markets, and the structure started to build, getting more asset classes. And I think that's what really took off was you started to have more coverage from an asset allocation model perspective where you can utilize ETFs, benefit from the inherent structure of itself in terms of tax efficiency, liquidity, daily liquidity and trading, but also the flexibility, and this led to other uses because you can go short in ETF. That creates liquidity, but also creates a different use case for, say, an institutional investor that more retail investors can benefit from because of higher trading volumes, better pricing information, et cetera.
Okay. Yeah, I can remember I started in 2001 as an advisor with Morgan Stanley, and we briefly knew about ETFs. I think like SPY and maybe like QQQ, and there was like a small cap. I can't remember which one that we were really aware of. I think most advisors at the time maybe knew about them, but they didn't really understand them. And like you said, it was such a small part of the business that really was focused more on the mutual funds still. Whereas today, a lot of people just only use ETFs to invest their money, it seems like, for a lot of good reasons, which we'll get to. Tell me a little bit about, people might not understand this, but how the ETF creation process works.
Yeah, and that's really where a lot of the benefits come from, this creation redemption process, where it's sort of a tale of two markets. It is primary and secondary market. So the way this works is ETFs are traded on the secondary market. So traded through an exchange like New York Stock Exchange, NASDAQ, where you trade your actual...
Through your broker, essentially.
Through your broker, right. That's the secondary market. Now, if I want to go buy an ETF and a market maker says, I have 10,000 shares to sell you and I want to buy 20,000, they will say, okay, we'll take those 20,000 shares. So I make that transaction, I buy my 20,000 shares of ETF XYZ. They only had 10,000. So there's a mismatch from their perspective. So what they can do then is tap into the primary market. So they say, okay, State Street, as the issuer, I need to come to you and create 10,000 shares of your ETF. And State Street, as the issuer, says, great, love to see that. But here's the list of securities you need to deliver in to actually create this ETF to actually create shares because it's an in-kind transaction. There's no cash that is transferred. So let's say it's 30 stocks or so. The market maker goes out, buys those 30 stocks, delivers them into us. We deliver those 10,000 shares back to the market maker. And now they have a flat position because they sold us 20,000 when they didn't have it. So that's that in-kind creation redemption process. You have demand in the secondary market. If that demand outstrips your supply of shares, you can go to the issuer and create shares to meet that demand. And the way the shares are created is through an in-kind process. So the market maker delivers in the underlying stocks for the units of those shares. And this works in reverse too. If, say, I wanted to sell my 20,000 shares and I sell them back to the market maker, they now have 20,000 shares that maybe they didn't really want. They had a lot of inventory or what have you. So they come to us and they say, hey, State Street, I have these 20,000 shares that are excess. I'd like to get rid of them. We're like, great, here are the securities back for them. And we'll deliver out in kind the securities that make up those shares to the market maker. And then they can sell those individual securities to whom they have, keep it in inventory. But that's the function of the primary and secondary market. Retail investors interact on the secondary market. When market makers and trading community have excess of shares, they can redeem them from the underlying issuer. So there's this constant flow of liquidity between the primary and secondary market.
Sure. So most investors, if they're buying an ETF, they have no idea that this is going on. They're just buying it in the secondary market, and whatever the price is that it's trading at the time, that's what they're going to get it for or sell it for.
Correct. Yeah. In the secondary market, not all trades need to go to the primary market. There could be enough trading volume out there between people buying and selling for different reasons. For instance, SPY trades, roughly on average about $24 billion a day. And not every single one of those transactions goes down into the primary market because market makers and the trading community, they have that sort of two-way order flow that can meet those daily liquidity needs. They don't need to go into the primary market because there's so much trading volume on that single security. So it's a really innovative structure that allows for a lot of flexibility. But then also there's that tax efficiency component because you're delivering those securities out in kind, which is a tax exempt transaction. But yes, ideally, you're only interacting in that secondary market, and the price that you're receiving from that market maker, your broker, is a derivative of what the underlying stocks are worth. So there's a natural arbitrage mechanism. If they were mismatched, someone could come in there and profit from that. And that's what keeps the ETF price and the NAV of the fund trading so closely together.
Yeah. So when you talk about a fund like SPY, the S&P 500, that's made up of 500 different companies. So then you also have the value of that at any given moment, and then you have the corresponding value of all the stocks in that fund. So those are supposed to match up, is what you're saying, right? So that there's no difference.
Yeah, and there's a process called the INAV, indicative NAV, that is quoted every 15 seconds of what the underlying basket of stocks should trade at. And that is helpful in sort of the formation of price discovery because when you price up all 500 stocks, what the overall value of that basket should be. And if it's trading outside of what that value is, then someone's going to come in and tighten that to bring it back into equilibrium. And that's a self-reinforcing arbitrage mechanism of the ETFs.
Sure. So talk a little bit about how mutual funds differ from ETFs.
So let's start with the similarities, sort of, and then you can kind of work our way back to the difference. Similarities, they're both sort of basket of stocks. They both own shares of other companies, and they're both utilized in sort of asset allocation models or strategic allocations. Where they differ is in their structure. So mutual funds only have really one leg of liquidity. If you want to redeem your shares of mutual fund, you put that order in, it goes to the portfolio manager, and then they have to raise cash to meet your redemption. By raising cash, that creates some sort of taxable event. It could be a capital loss, but anytime you trade, that's a capital event. So that's different because ETFs have two legs of liquidity, that's secondary and primary market. Then also because of the in-kind redemption process, there's a tax efficiency. Then there's also the difference where you only have sort of one time of transaction in a mutual fund, and it's at 4 o'clock. At ETF, they trade continuously throughout the open market hours between 9:30 and 4. If you want to rebalance intraday and have a part of your portfolio that's maybe more tactical, more dynamic, and there's perhaps news that comes out that all of a sudden changes your viewpoint, whether we've seen a lot of news this year where that could have happened, you could trade instantaneously and pick up the price performance of the S&P 500 from noon to 4. Now, you could have the same similar reaction as a mutual fund holder, but you would not get that price at noon. You'd get it at 4 o'clock after that run up. So that's some of the bigger differences, is that you can buy and sell an ETF at any point throughout the day. You have a dual legs of liquidity, a primary and secondary market that creates tax efficiency. There's also in the nature of transparency. The holdings are revealed every day within an ETF. In a mutual fund, it's usually on a quarterly basis, sometimes monthly. So it's that transparency, the flexibility, and the liquidity that really sort of show up also with that tax efficiency for ETFs relative to mutual funds.
Yeah. Like you said, if you want to buy a mutual fund, you have to put, or sell one, you have to put your order in before 4 o'clock. And then at the end of the day, the value of the underlying investments in that, if it was stocks, are added up to determine what the closing price of the fund is. And that's what you buy or sell, right?
Correct.
Whereas a mutual fund, or an ETF, I should say, whatever it's trading at the second you put your order in is what you get it for. Or if you used a limit order, right, you could set your price.
There's more control of your execution when you're buying and selling for an ETF than there is for a mutual fund. And I think that flexibility is really important, particularly in markets that are proven to be quite volatile.
Yeah, for sure. Yeah, I mean, I would say back in March, people that were, as the market was bottoming out, or if you were trying to get in or out, you were maybe happier if you were doing it through an ETF because you had control over days where the market might be up 1,800 points or down 1,800 points. Whereas a mutual fund, you're waiting to the end of the day to see what happened, what your price is. Yeah. You talked earlier about the taxability difference. Talk a little bit about how the ETF can, or how it maybe generates less capital gains tax than a traditional mutual fund.
Yeah. So one of the first ways is, again, if I hold $1 million of a mutual fund and I want to sell my shares, the portfolio manager on that mutual fund basically has to raise $1 million in cash. Now, I've left and I don't have to pay any associated taxes as a result of them raising cash. I've already left the fund, but the existing shareholders do. They have to sort of pay for my actions. And, anytime you touch the primary market, the cash market, you could create a capital event. And that's what we typically see. We've had a lot of redemptions out of mutual funds over the last few years, largely in the active variety. And they've had to generate cash to pay for those redemptions. And that creates capital events. And there's been a lot of capital gains. So that's one of the reasons. The other reason is that within the ETF construct, not only, so you have, again, that same example of around me redeeming $1 million, that could just go into the secondary market if there's enough volume to support it. Again, for SPY, it trades $24 billion. And I don't have the million, this is all hypothetical. My million hypothetical shares, that could just be absorbed by the market and it never has to touch the primary market at all. And even if it did, that primary market transaction's in kind. So that redemption leaves the fund and it has no bearing on from a tax perspective. So those two aspects are really important. Not all trades, go into the portfolio manager. And even if they do, it's through an in-kind process. And that sort of shields the ETF investor from capital gains events more so than in a mutual fund. Because in a mutual fund, you're constantly sort of churning the portfolio and creating capital events.
Yeah. So the typical investor that owns, let's say, an ETF SPY, right? If they hold it over the course of the year and the fund is up in value, the odds are pretty low that they'll get a capital gain 1099 or 1099 showing they have a capital gain on the fund if they didn't actually sell their holding, right?
Correct. Last year in 2019, only about 3% of all ETFs paid capital gains, where I believe the mutual fund space, the average was around 60% paid capital gains.
Wow, that's a big difference, yeah.
And in some Morningstar categories, it was upwards of 80% of the funds pay capital gains.
Yeah, that's a large number, and obviously that can make a big difference in how much taxes an investor pays at the end of the year on their mutual fund versus an ETF. So we're going to stop there for this week's interview, but we're going to continue our discussion next week, so please tune in for part 2 of my interview with Matthew, where we'll talk more about ETF taxation, talk about passive investing, and also some strategies to help you select your ETFs. And as a reminder, if you're looking to get your New Year's resolution off to a good start, my retirement readiness workshops are beginning in February. So you can go to my website, morrisseywealthmanagement.com, to find out the dates and locations. Have a great week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.